Rafa, can you hear me?
I can hear you. Can you hear me?
Yep, perfect. So yeah, let's give it some minutes until more people can connect. We can start around 4:33. But thank you very much for connecting in time.
Right. I see a few AI note takers. Everyone's popping up.
Yeah, yeah. You send the AI note taker and then you might see it later. Perfect. Game. So yeah, let's wait a couple more minutes and then we can get started. Game. Okay, let's wait a bit more. I see also familiar faces. We'll wait one more minute to start. Okay, a bit more. We always like to start exactly 3 minutes after scheduled.
That's better than I thought for a Spanish standard.
Yeah. Still, then there's like 2 or 3 more minutes where people keep joining, but yeah, out of respect for the people that connected on time.
Yeah, and
Perfect.
of course.
Great. Okay, so I think we can get started already. So, well, first of all, thank you very much for connecting to this webinar. Like I'll introduce me and the Startup CFO briefly, although I know that some of you either know us pretty well for different reasons, or you guys may have watched other webinars that we have given in the past. So, well, my name is Jaime Medina. I'm the CEO of the Startup CFO, and we offer fractional CFO services for startups, both them operational parts on the day-to-day reporting, forecasting, finance operations, and also on the what funding does the company need. And on that, we provide services of helping you obtain public funding, bank funding, alternative funding, or private funding. And in fact, this is something that we have been insisting so much in everything we have done. So we have, for example, our academy courses that is like a spin-off part that we do, which is courses on startup finance that we offer 2 editions per year. And in all our webinars, we keep insisting all the time in alternative funding. So it seems that in this startup world, in this venture capital world, everything there is venture capital. And I find it funny because many times I use this argument with many of our leads. They say sometimes like, but like, why would you get alternative funding? Why would you get debt if you can get venture capital money? And it's funny because I use their argument. I tell them like, look, you just closed a funding round with a post-money valuation of 5 million. And you tell me that in a couple of years, you will do another round with a pre-money valuation of 15 million. And I'm like, you claim that your company is going to be worth so much in 2 years. So every bit that you don't give to venture capital, you are going to keep it to yourself and it's going to be worth a lot of money. So I think that alternative funding is certainly something to keep an eye on, and many more opportunities and many more providers and many more structures keep popping up. And in particular, I'm following that, I'm making the intro to Rafael. Recently, we have started collaborating with Lendity. And Lendity is, in my opinion, one of the most innovative in a way, opportunities to get funding for a startup, because there's not so much that looks like it. But on the other hand, it's also the loan and like a loan for startups, and of course, loans have existed for a long time. So Lendity started in Switzerland. And well, on that, I'm happy to introduce you guys to Rafael Caramanzana, CEO of Lendity, based in Switzerland, and that will accompany us today. So I will let Rafael explain to you guys more on alternative funding and Lendity for 15 minutes, I guess, something like that. And then happy to start to create some dialogue and some questions regarding like all types of non-dilutive funding. So, of course, I don't think, like, if you guys have any question, please either use the raise hand option on Zoom or write on the chat or however you guys want. I'll be paying attention to the chat. And yeah, like, I just shut up now and leave the floor for Rafael.
Super, Jaime. Thank you very much. It's a pleasure being here. I run Lendity. Lendity is a Zurich-based firm specialized in providing a tech-enabled private debt. What does it mean concretely? We provide growth loans for scale-ups, for tech scale-ups. And this is a new sort of capital that is available today for tech companies that was not very available in the last, let's say, 10 years. And as Jaime put it, it's a tool that we think should be in the toolkit of any scaling tech companies. Lendity started in 2018. We run several strategies, and we have our own fund that is based in Luxembourg. And to date, we have made investments going beyond 100 million Swiss francs or euro equivalent. We take a look at the specific companies that are in a certain growth path and are healthy, and we support them with capital that we believe is more efficient. But as Jaime said, this is not for everyone, in the same fashion that VC or venture capital is not for every company at every stage. So what I want to do is tell you a bit about how we look at things, what we do, and what is important and not. And if I'm going, too slow or too fast, Jaime, just let me know that we make sure we leave enough time to make this interactive for everyone to make questions. I'm going to show my presentation. Just let me know if you can see it.
Okay, I can see it, so I guess all of us can see it already.
Fantastic. So, I'm gonna go very early, and just probably this is very simple for everyone. But I want to make the point extra clear. So, any company that's starting needs to prove many things. Needs to build a product, a service, needs to sell it, needs to grow it, and there's no other way that you do it with equity, because basically you are creating a lot of expenses and investments. And the only capital that's available out there to make this, it's capital that believes your team, believes your vision, but there's nothing concrete, and that is equity. Now, as companies mature...
Yeah, on this, by the way, sorry, like something that maybe to us seems obvious, but we see many entrepreneurs that are just starting that they say like, okay, what about banks? What about like other sources? And it's like, well, I'm sorry, but like if you're starting a startup, which by definition has a lot of uncertainty, and you're just starting and you didn't prove anything, nobody's going to give you 1 million to get a 4% interest. Risk 1 million for a 4%. That's only obviously if you are established, and that's why each type of funding is adequate for each stage. So in this case, yeah, like you need equity, because sometimes it's like someone would tell you, I give you 1 million, but I share the profit with you. And of course, this is the only alternative for very early stage.
Exactly. If we're sharing that risk with you, should be rewarded with the upside. And by the way, our vision, or the way we see at capital, is we want to see the right capital for the right use at the right time. And I think that changes as companies evolve. But there's no questions asked. If you're starting a company, you need equity. Someone should believe in you, friends, family, fools, whoever it is. And as you start to mature, other sources of capital will become available. But when we talk about equity, it's like everyone believes this is VC, and everyone makes the reference to venture capitalists. But the reality also, VC is not for everyone, it's not for every business, and actually just for the few minority. When a VC makes an investment, they need to make sure that at least there's a potential of creating a 10 to 15 time return on that investment. And this is only valid if the company is actually catering to a very large TAM, a very large market, should have this ability of being the fund returner, being a unicorn, having exponential growth. It's not enough to grow 50%, 60% for a VC to make an investment. Otherwise, this will create problems down the road that we can see afterwards. But you need to make sure that you can grow 3 times in 1 year, the so-called 3-3-2-2. And it's probably better catered for companies that are in the winner-take-it-all market. Now, when you're not in this space, I think it's much more intelligent to focus on acquiring equity from different sources, because otherwise this might create misalignment with VCs, and at some point this will pop up, and you don't want to either lose your company or lose your time. And also one thing, most of the entrepreneurs we talk with, they don't want to be the next Elon Musk. They just want to make sure they build something that they have in mind, build the right team, and have what is called a life changer in terms of monetary compensation. But they don't need the Elon Musk journey of 20 years or whatever that comes on a personal level, or be a fund returner.
Yeah, I always say, like, do you want 1 in 3 of chances of doing well, or you want 1 in 1,000 chances of making 100 million? Like, okay, your choice. Mine is clear, but I'm not saying it's better or worse, but like, it's certainly you should really think that through.
And I think the vast majority of entrepreneurs that we face, mostly in Europe as well, are more focusing on that. So it's very important to make all these thoughts before you decide which capital strategy you follow. But now I just want to talk a bit about debt. Why debt? What are the advantages of debt? Of course, when you get debt, as opposed to getting equity, when you actually sell equity, you're selling a portion of your company. With that goes the shares. With that goes the terms with the shares, the control, and sit on the board, and so on. And this is the so-called dilution that equity creates. Now, equity is needed. Equity is very needed in certain specific business verticals, but not for everyone. Or at certain point, your company might be in a certain maturity stage that more efficient capital becomes available. I think a few points on debt. Many people think about debt as last resource, when actually when we end up engaging with companies, the opposite thing is they have reached a maturity level that they're privileged that debt becomes accessible to them. And of course, debt provides the lowest cost of funding. In terms of cost of funding, I don't want to get too technical, but whenever someone makes an equity investment, they expect a certain return within a time horizon, and that's typically measured in what is called the IRR, the internal rate of return. And when VC investors make an investment, it's unlikely that they expect anything below 50% on any single investment. The reality that debt has probably a cost of funding that is around a third of that. And that's clear, one of the benefits. Now, unlike equity, which you need to pay it by the end of the life of the company or whenever the exit happens, debt should be repaid at some point. And that's something very important to keep in mind. I go a bit faster, Jaime, just to make sure we enter why. Why now debt is an option? Well, there is a change on how tech companies starting to actually bill their clients. For those of you that are a bit older, we remember buying software. We used to pay upfront a certain amount. We would have a lifetime product, and we don't need to pay any more subscriptions. Now everything changed. We're paying every month. And when we are in the B2B space, these contracts tend to be very long, very sticky. Once an enterprise decided who's going to be providing the software, it's unlikely that they make very frequently. And the fact that we're talking about new tech stacks and the existing SaaS solutions that exist, for example, in reporting, we have a granularity on data that was unthinkable of 5, 10, 15 years ago. And that granularity of data allows us to feel comfortable with the companies that are by definition cash flow negative. And one of the questions that always pops up is, well, okay, why don't we go and discuss with a bank and see if we probably can get a loan? And the reality is that banks have a very traditional lens on how they can assess a company. And as soon as you show that you are burning cash, so you're cash flow negative, this is typically raising all the alarms, and there's nothing else they can do unless there's another angle where they can make money, or there's a personal angle as well.
Exactly. That is super important. Like in our academy course, like the first case that we solve is on Uber, and we explain why, like, if you keep opening cities, then they are going to be unprofitable at the beginning and then profitable. But you may want to accelerate your growth and say, like, okay, now let's open 5 more. And then when you're about to make them profitable, to say, now let's open 15 more. Now let's open 20 more. Uber lost money for a long time. But it can be, I mean, obviously you can do it wrong, but it can also be like a perfectly possible path in which you like raise rounds in order to burn the money and invest to keep the customers now that will bring you the profit in the future. And this is something that, as Rafa was saying, banks often don't see. It's like if they will lose money, this is not going well. Whereas it can be a perfectly sound and reasonable investment.
Exactly. That's where we feel really good about it. We only engage typically with companies that are cash flow negative, but we want to make sure we analyze this data in a granular level. And we want to make sure that when we look at the P&L, they have the ability to move into profitability if they wish and cut those sales and marketing expenses that Jaime was saying. So this is part of our analysis. And this analysis, it's also very much based on the fact on how much is a company acquiring to expensive to acquire certain clients, how long are these clients staying, does it make sense to have that level of sales and marketing, and is that that actually expense coming back, the so-called client acquisition cost, lifetime value, CAC payback metrics. And making an analysis here was impossible 5 or 10 years ago. Now, it's not for everyone. The company should be in a growth momentum. They should be running an efficient business, efficient as in, once again, they have positive unit economics. They will spend 1 in acquiring the client, and more than 1 should come back. And that should be provable. The clients that they onboard are not disappearing after the first renewal. So we take a look at this sort of data. The margins should be healthy, and as defining what's healthy on, probably on a SaaS space, typically we end up restating P&Ls unless we work with someone like Jaime or his team where we have very good data quality, but want to see gross margins that are 75% or more. That there's no one single client representing probably 40% of the revenues of the company, or the company already has some loans, and this will put the company on over indebtedness. I can quickly talk about what we look for in the companies, but I want to make a pause to see, Jaime, do you have any points you want to highlight?
No, yeah, please go ahead. I mean, I have many, but also like I'll let you go ahead, and if anything, if I have any remark, I'll stop you.
Super. So we want to see that the cash flow is predictable. Predictable as in, are these contracts long term? Are they renewing at the right pace, or is there a lot of churn? That the growth potential is there, and the whole business case makes sense. That so we do what's called a cohort analysis, just basically visualizing what's the retention on every client cohort that has been acquired. This can be monthly, quarterly, and this is all, by the way, something that we do in-house because we need to check it regardless on this has been produced or not by the potential borrower. We want to see that the expenses make sense, are reasonable, that if the company it's a high-tech company, we want to make sure that research and development expenses are there to make sure that the product features and the pipeline of product features are there, but at the same time that they're not using a crazy amount of money, because this is probably more an equity case. We always want to see that there's a path to profitability, and path to profitability means that the company has the ability to keep running in a break-even mode if they choose to do so, but not necessarily do it. So as Jaime said, if in the Uber case, in case they're about to reach profitability, but they decide to keep going the burning mode, we're okay on that, but we want to see the ability to be able to do it.
Exactly. There are many things to comment here. Like, again, like if you prove that, like whenever you open a city, imagine you prove already like small, medium, and big cities in the example of Uber. They can follow this trend of like at some point they become profitable. Then, if needed, you can like pull back, okay, like the investment in the new ones, and you just can take the profit from the past ones. And also, by the way, in case of software, that I'm sure many of you guys here work on software on SaaS, we have seen many times clients of us that they were doing like they were like growing, but like maybe not VC speed. Then they were not able to raise a new funding round, and they had to become profitable. And the good thing is that they can. Like if this is why, for example, I see here many things that make a lot of sense, like the retention rate. If your clients are truly recurrent, then if needed, you could decrease the size of your marketing and sales teams and your tech teams, and then be profitable and be able to pay back the debt. This is like very different, like Rafa was saying, to like finance in other sectors, or like finance 20 years ago in sectors that didn't include subscription based revenue. Like my father has always worked in finance, and he wouldn't understand most of this slide, but there are startups, like the subscription model allows that this is like, okay, the right KPIs to look for, even in a company that burns money, and that it can become profitable whenever they can, in quotes.
Absolutely. And for us, it's so important to get that data quality, because all our underwriting goes into understanding that and taking those numbers. So we had cases with the team where we had to restate everything. That's why, it's a pleasure to see the quality of work that you guys do. And this is not a minor detail. When you engage with any lender or any investor, we actually have in our own scorecard, one point is the housekeeping quality, we refer to it. And how are the financials, how accurate the financials, how well are they built, are they professional, are they following professional rules and so. And the fact that you have that properly done, it's a very positive sign for any investor.
Yeah. By the way, one question already, thinking that there may be someone in the audience from the financier point of view. And we have received this question from banks very often, especially when I give training to banks, which is, how can you audit these KPIs? Because in the end, they are not like accounting, they are not formal, they can have like different definitions and stuff.
Yeah, that's a very good point. I'm laughing because we have someone from our team on the call who has been performing this recently for a transaction we're about hopefully to close. Yeah, so we need to restore to many. So when it's audited, it's an easy one, right? Because you can rely on the quality of the auditor. But if not, you need to use different sources of data. We ask read-only access to bank account or to obtain the statements. If they're using any billing software like can ChargeBee or anything, we can get direct access to statements from Stripe, and then we do the whole number crunching. So they provide the CSV files or the read-only access, and then we do everything. And by the way, at the end, what happens is typically we end up performing a whole analysis of the company that we present to them, and this shows a lot of findings that they were not fully aware of. And this creates a lot of value for them and establishes a very long-term relationship that even we recently had one of our borrowers ask if we can join the board. We are a debt investor. And typically debt investors, they don't necessarily join the board. But one of them said, "Look, you push us in the right direction. You show us some insight. We want you to keep doing that for the duration of the relationship."
Yeah, indeed. I mean, that's a wonderful proof of like, okay, then certainly like if you want to look at the right KPIs, you're gonna build the right KPIs. And then by the way, like nobody could like it's not easy to fool someone on this. Like it's very easy to detect if data is inconsistent. So certainly like there's a lot of value into this.
Yeah, we recently had to do a whole inflow and outflow analysis on bank statements. We cross-check this information, and at the end, I highly discourage anyone trying to, not us, but I mean, because we will have that check, but eventually hiding something would pop up, and it's going to be typically detrimental for the company. So easy use cases, there are typically four. It's accelerating growth, the bridge financing, actual path to profitability, and inorganic growth. So acceleration growth is, as you said, the first example of Uber, but within the same, if you want the same geography. You have a go-to market that worked, you put one, you're going to extract three. And just basically you need to acquire more, you need to hire more sales representatives, probably increase your marketing budget. And this works, and because you already did in the past. Unlike saying, we've been doing this in Europe, now we're going to Middle East, we want to replicate this. Well, that's probably something more for equity than for that. The bridge is generally, you're doing fine. Markets are not looking good. You still have good unit economics. You could go out to the market now and raise money, but for whatever reason, you might benefit from a delay. And once again, this is not the last resource funding. It's actually the opposite on that. This goes hand in hand with the next one, which is extending the runway. It can be, we are working, for example, on a few large accounts that we know we signed. This will take probably 6 to 12 months to onboard them, but this is already contracted. And once this revenue becomes live, our ARR is going to be in different place, and then our valuation as well. It makes a lot of sense to actually use more efficient capital until that valuation kicks in, that new revenue kicks in. And of course, once they raise the equity, the dilution level is significantly lower. This happened to us with another of our clients. They have very, very large client base that already been signed, but because the type of service they offer is client facing, they can only do onboarding once a year. And basically it doesn't make any sense to raise today. They could actually postpone this and retain much more enterprise value. And the last one is to, just basically go out there. There's a lot of what we call VC orphans these days, companies that did very well, but somehow the cap tables are broken. They're not growing anymore, but they have a decent user base. Everyone wants to exit. What if you can go out there, use the revenue of your target company to actually finance this acquisition, and then we can support on that as well. Debt has benefits for everyone. It's not only for the founders, it's also for the teams who got stock options. It's also for the VCs that probably will need to keep their reserves for the winner takes it all type of company, the unicorn potential. And you don't, sometimes happens that companies that are not the fund returner are somehow ignored by the VC, and this is a tool also for them. You don't need to change any valuation, shareholders agreements. You don't need to go through a lot of the tough talks. And by consequence, this is a way faster transaction. Mm-hmm. That typically, the fastest we have done from early discussion to execution is below 4 weeks.
Yeah. By the way, I want to talk a bit on like many of our founders, some of our founders are like concerned about the cons of getting debt. They are like, okay, fine, but so we see that, for example, many of the founders are scared or afraid of like, what if the company doesn't go well and I need to give it back? And if it's a limited company and you do things right, because obviously there needs to be like some good faith in the administrator and all those legal processes, the debt is in the company. The institution that gives the loan obviously is undergoing a risk, and the risk is on your own company. And of course, not being able to pay a debt is a stressful situation. But if things are done right, it doesn't go against the wealth of the founder itself. And I think, like, especially I see it in Spain and coming from the financial crisis of already 15 years ago, but we see that many people, like the word debt, they're pretty scared. And again, everything has pros and cons, and everything has the right use. And if you already started on the scale up or like the later stage startup, certainly debt starts playing a role there, and there's nothing to be afraid of. Again, it needs to be like a responsible use. Companies don't have to be over indebted, and you need to do things right. But certainly, like that's a con that many times don't make as much sense as founders think.
That's a very good point. I mean, I think it has probably a psychological component to it. But I want to highlight it. Yeah. So when we make a loan, we assess the capacity of the company to pay it back, and it's on our own interest to only grant a loan to a company that will pay it back, because a default is a disaster for everyone. Now, we are going to be the first ones saying no, and actually we have to say no many times. The reality is that you have everything on the market. We had a case this week where we were very surprised, because it's not normal, but a bank offered better terms, like lower cost of funding than us, but ask the founders for personal guarantee. And this would require the founders to answer with the debt. That's not normal in the industry. And what we do is we don't ask any personal guarantee for any of the founder. We just ask the assets of the company to guarantee the payback of the loan.
Yeah, we discourage it always. Like we say, especially again in a startup. In other types of businesses, it may make a lot of sense. In a startup with a lot of uncertainty, we always discourage founders to put up personal guarantees.
Same here, but you have all the flavors in the market, and yeah, you never know. But it's a very important point. We don't ask for any personal guarantees, and we enter in a long-term partnership. This is something in a very symbiotic relationship.
Can I comment?
Yeah, sure.
Sorry. So my comment I was going to make about the debt is, and this comment / question, but basically, as an entrepreneur, you should raise debt when you think that the enterprise value you're getting is higher than the percentage that it costs you, right? The interest rate. I mean, that's where my con was more focused on. That is like, if you raise debt and you think that with the debt you can increase the enterprise value, then it's a no-brainer. Of course, there's risks, right? But that's the no-brainer to me. If you raise debt and it costs you, let's say 10%, 15%, whatever it is, and you're not really able to increase the enterprise value, then you're actually shooting your own foot. Isn't that more or less right?
I think that's accurate. For any type of capital you use, you need to make sure that you create enterprise value. And debt has a lower cost, meaning that the enterprise value that you need to add for justifying a debt transaction is lower. The burden is lower than equity. When someone raises equity, no one thinks about it as cost of funding, but it's unlikely that any equity transaction will result in a cost of funding that is below 50%, 40% IRR. That being said, the only use of external capital is because you can create more value. And by the way, I think your point is very good, because we also built an in-house, what we call an enterprise value calculator, in a way of saying, okay, this is the money you will get, this is where you will spend it, this is the return on investment of this spending motion, and this is the enterprise value saved for you or for every shareholder. But yeah, I think your optic is the right one.
Thank you.
Liz, you're welcome. A few things that we find out that are not necessarily the typical problems when one sees underwriting a company. Probably, the P&L looks great. and this would be a P&L that we would engage, but we end up not engaging. It's what we call broken cap tables. And what is a broken cap table? In the last, let's say, from 2021, 2022, a lot of companies raised at crazy valuations. And then we know what happened with equity markets. And in 2023, some of them ended up raising extension rounds with very unorthodox terms. What happens is that we question what is the founder in the money? And what does it mean, is the founder in the money? Is when we take a look at the capital stack, and this means all the preferential terms that are sitting on the balance sheet of the company, will the founders ever grow to the last valuation or to valuation that will create any potential exit for them? And if not, it means that the people who are driving this value creation are not motivated enough. And then we unfortunately need to say no to a transaction. Do you think that went through well, Jaime? Did you understand the concept?
Yeah, I mean, in the end, it's similar, this part of what VCs look for as well. Like, how motivated are the founders? If the founders have 2% of the company and there are like already 5 VCs that have more money into the company, they may be like, okay, so thank you guys, you run the company. Like, I am an employee, no longer someone that is like truly motivated. And that can happen not only by like a strict dilution, but also by the liquidation preference, which is a slightly more complicated concept, but in the end, it's also similar. Like, would they get profit if the company is worth what they think it's worth? Yes or not? And if the founders are not, you can't be so sure about the management team, like if they will leave the company, if not, or if the project will continue, etc.
Exactly. That's very usual. It happens because people ended up raising at multiples of 20, and then multiples compressed. And now our analysis, we wrote an article about it, but probably companies that raised in 2021, 2022 and went for the higher valuation might now need to grow at 50% year on year for 7 years in order for them to actually get back to that older valuation, which it's of course very demotivating for anyone on board. Just to match evaluation means no further exit for the team. But we saw the flat rounds and things happening like that. We have a lot of content in our website. I encourage people to subscribe to our LinkedIn channel and follow us. And let's open it up really for discussions.
So, any question from the audience, you guys? If not, I have like some myself, and of course, in any case, you guys can like cut us in any time. So, well, I wanted to ask you, Rafa, more on like Lendity's structure of the debt. So, in my opinion, it's the one that like we hadn't seen yet, and in my opinion, is super useful for at least many of our startups, certainly.
So you mean about the structure?
Yeah. So like the duration of the loan, the amount,
sure.
the requirements and stuff.
So we are flexible in the way we structured, but we see the best fit on doing long-term loans, and long-term meaning up to 5 years in tenor. We have the ability to disburse in different tranches to align the efficiency of the use of that capital. Amounts typically go anywhere from 50% to 80% or 100% of ARR or annual revenues if they're reoccurring for some companies that have good metrics. Typically, in what's a bit more technical, but we are typically senior secured lenders. It's akin to equity investments when you have preferred equity investors and common shares. We are more like the preferred ones because unlike an equity investment where the equity investor has upside in whatever value the company is creating, we don't have more upside than the fee that we charge. So this is fully non-dilutive. We don't ask for any warrants or options. but we have 100% of the downside, and that's why we end up sitting on the higher side of the capital structure.
Perfect. Yeah.
And
Well,
yeah,
sorry,
sorry.
continue. Go ahead.
No, and the rest, we are flexible in terms. I think our ability is to be fast, to execute something really, really tailor-made for the company, and we really like to see this as a long-term partnership. Otherwise, we don't engage.
I see. In my opinion, and well, I see a question on the chat, by the way. Again, you guys feel free to add more questions. I'll reply to it. We'll reply to it soon. But I want to emphasize a point here that if anyone was not paying attention because you guys are replying to emails or anything, I think there's a very important point on what Rafa just said, which is the long-term loan. And up to, well, you mentioned 50 or even 80 or even 100% of ARR, you mentioned. This is something unlike we had ever seen. And we are CFOs of startups, and we have been for 6 years. So we have worked with 300 clients. So I think we had already seen several things. This, in my opinion, is game changer. And it aligns a lot with the founders and with the project itself. A startup is always a long-term bet in any case. So there are a lot of short-term lenders in the industry. I will ask you later, Rafa, your opinion on those. But certainly long-term lenders, not so many. Certainly not so many on an amount that can be completely game changer for the company. And on that, I wanted to ask you one question because I know the answer, and I think it's pretty cool, which is your default rate. If I'm not wrong, you guys have had
0. Yeah,
exactly 0.
We didn't have any defaults. Might be that we are more on the safer side, but when we, as said, when we engage, we want to make sure that this is for the long run. And I don't think so. When we analyze data and we see a proper P&L, a proper housekeeping, we feel really confident when we engage. We see the numbers, we see the ability of the company. And by the way, also worth mentioning, what's the stage where we typically engage in a company? It's not when the company has less than 1 million revenues. Typically, this becomes, for many reasons, interesting when the company has probably is on track to hit 1.5, 2 millions plus.
To me, this is super interesting and super important. Some lenders that do, banks provide long-term lending, but not to startups because they don't understand how they really work, and they are afraid like they're burning money. They are not going to give the loan back. On the other hand, there are some others that are like, I'm willing to give debt to startups, but for short term. So like you spend this money on marketing and then you will receive it soon and you will generate it. But we're talking about very short term. But as we were mentioning before, that once the company has some revenue or if the investment is controlled and supported by good unit economics, then you can make a long-term bet on the business and then have 0 default rate. So that's why, in my opinion, is a super important point. Maybe like more from my finance glasses, but certainly very, very interesting.
Yeah, I wanted to also, yes, just one remark there. When you compare this with more shorter-term solutions, I think those are those deserve also a place in the toolkit of any CFO. The thing is the use case. It's very important what you use it for. And when we do B2B, everyone knows that sales cycles are long and even longer now. And I would really not, this encourage people to engage with any sort of short-term financing for a long-term need. That's a crazy thing to do. Now, but if you're running an e-commerce and you need to build your inventory because Black Friday is coming, yeah, okay, just go there. A 3 months, 6-month facility will make sense. Anything else, B2B space, less than 3 years, I think it's a crazy thing to do.
Great. There is a question in the chat from, I don't know if Simon or Simon. It says, could you elaborate on common liquidation preferences and anti-dilution agreements and their effects, potential red flags, etc.? I think, Rafa, you can go ahead. I'll give my opinion too.
Yeah, I just quickly from our side, thing is, it all boils down to what we call, are founders in the money or not in the money? do founders have enough incentive to keep running these 5 years, which is our loan tenor, or not? And when someone provided what we call, they didn't want to do a down round in tough times, and they sugar-coated a transaction with liquidation preferences, or these are benefits for investors on the detriment of the common shareholders. And if we see that they've been very aggressive on that, despite the fact that a company might have a fantastic P&L, we cannot engage, because the ones driving the vision are not going to be motivated enough.
Exactly. The way they work technically, for the ones that may not be so familiar with it, is an investor may require that they say like, okay, I give you 1 million euros in this funding round, but whenever the company is sold, like the first million goes for us. And then we talk. This is like briefly, and it can be more elaborate and it can have other multiples, but like, I hope this is enough. So yeah, like the first money comes back to us, and then we'll talk with the rest of the money. This means that if the founders, and this is why raising at a very high valuation or raising more money than you should, it's a mistake. By the way, like all of our clients, well, I will say most of our clients, so that they can, like some of them will not feel insulted, but many of our clients, they want to see like, okay, the more money, the better. And I understand it. And sometimes it may make sense. But then what if that money comes from a liquidation preference? Then if it was a lot of money and the company doesn't do well, then if the value goes down, then maybe you find yourself in a scenario that if the company is sold, you get €0. That the CEO may not know so much about liquidation preference before the round, but certainly knows a lot about them after the round with liquidation preference. And then they may see that they are like, okay, I'm not invested in the company anymore. Like with realistic valuations, because things didn't go as well. With realistic valuations, I'm not going to get reasonable return if the company is sold. So this is why they can be like out of the money, like Rafa was saying. From that moment on, they are employees, essentially, for good or for bad, but they are just employees. And therefore, the driver of this vision with so much uncertainty is not in the money, which I have never used the in the money expression, but I think it's pretty visual too.
Yeah, it's from the option trading, but at the end, we end up, so we see a few companies like this. I'm sure there's a few of them in Spain as well, and we end up helping them doing what we call the reset of the capital, because it's on the interest for existing investors. And this is not that if you are in that situation, it's not over. You can reset it. There are ways of reshuffling everything again and providing the right incentive. By the way, Jaime, it's getting darker here in Zurich before Madrid. That's why you see I have very bad lighting, but no worries about it.
No, it's fine. It's fine. So, well, any more questions, guys? If not, I have like plenty of talking to do with Rafa. Anyway, if you guys have it, like please directly unmute yourselves or write in the chat.
And any of the bots can ask as well.
Yeah, absolutely. Soon they will, probably. So this is a tricky question and a bit like evil, but what's your opinion on other alternative funding providers? Because I think each of you guys, that we see it firsthand from the client perspective, each of you guys have like a slightly different approach, or like slightly different use or slightly different pitch. So what is your view on like, okay, if this is your situation, then this type of funding makes more sense? Or maybe like, I don't think these guys are betting on the right bet or not, because XYZ. Of course, you have given to this topic a lot of thinking, so I'm sure that your answer is valuable.
Yeah, I think look, I think anyone who's doing a business that is not generally aligned with the interest of the ecosystem, eventually they will fade out. And we see that happening. People come in and then they leave. I think more about the responsibility of the one taking the loan rather than the one granting it. And one needs to really face the mirror and say, okay, I'm getting into this. This is my funding strategy. Does this reflect what I can, what I need, what the company needs, and what the company opportunities in front of us to execute? Or am I getting whatever I can and I'm kicking the can down the road, and it's going to be a problem a year or two? So I think you have everything in the market, and you have many things that are very useful. For example, you have the traditional venture debt that they will invest right at the point where you close the venture capital transaction as a way of leveraging that round. So you raised 10, they will come in and say, okay, we put 5 more, but they're not underwriting the company itself. Most of the underwriting is on the sponsor, on the VC investor, who the VC investor was. If they invest, I put a bit, more or less blindly. And then on the other end of the spectrum, you have ones that are, what I don't like a lot are those that they frame the cost in a way that it's in disguise. And they say, okay, we're gonna fund you. We're gonna give you 100 and the cost is 8, but you need to pay it back in 6 months. And they disguise it in a way that 8 they present it as this is an interest rate or the equivalent of the IRR. Whereas when you run those numbers, you see that 8 probably looks more like a 25. So, but once again, I turn it around to on your point. I think it's a responsibility of the borrower to be well prepared, and if not, ask for help to people like you, for example, and run those calculations. Just open an Excel. It's super easy, and whenever anyone in the audience needs a hand on this, we can help. But I think, it's more the responsibility of the borrower.
Perfect. That's a polite answer. So, pretty good. And what about venture debt? Again, I have my own opinions, but I want to hear yours.
Venture debt, I just made a comment about when typically they're very restricted in the eligibility criteria on the timing when they can engage. And by definition, that removes a lot of the ecosystem. So they can engage when or very close to when the equity transaction happened. And they will charge an interest rate that can be something, comparable to other options like us. But on top of that, they will have what it's called an equity kicker or a warrant. And this gives them the ability to buy shares of your company in a future time at a given price. So basically, if the company does very well, the venture debt company will end up buying shares and then sell it. I think they have a place in the market. I think they have a place in every CFO toolkit, and it's probably better geared to companies that are on a later stage. If you need to put in a stage, Series B, Series C plus, where this looks more like a private equity play, like we started to see a few companies that were like VC and then maturing more towards the private equity space. But I think it deserves the place there. There's great people, great teams working on this, and I wouldn't say that in generalizing that this is negative in principle. No.
I see. Yeah, to me, certainly it has its place. I remember one of our clients. He said like, did you see this? This is outrageous. And they said, these are worse conditions than the typical like a TV commercial number that you call and they give you 500 euros on the spot. And they told us it's worse interest. And on top of that, I have the warrants. And on top of that, this is outrageous. And then I replied okay, you're complaining about this, about the venture debt, but simultaneously, you just raised a funding round. And again, following your own pitch of how much your company is going to be worth, then it's a much worse deal. If you had to repurchase the equity you're selling now in the future, is a much worse deal than all this interest. And by the way, very often, startups don't have a line of people waiting to give them money, but rather they should get what they are offered if it makes sense. So certainly I think it has its place on the market, and that first minute critique does not make sense so much. But it's true that something I don't like, and I do like in alternative funding providers, is that venture debt is often extremely complicated. The deals are not standardized. So it's not with a bank loan, you need to look at the amount, the deferral period, the maturity, the interest, the collateral, and I think that's it. With a star, but I think it's essentially it. With venture debt, is that each of them will have like 20 things that are not the same 20 categories that another deal. So like in order to compare, in order to make sense of this, I've seen many of our clients like having extreme complications just to evaluate them. So that is something that I really hope at some point it becomes a more standardized thing. Because now, like to me, every time that we need to do it, it's a headache.
Yeah, I think that's valid across the whole stack. Even you will find that because someone who's building a company is not necessarily excited about learning the finance side of it. But you realize as you need more tools, as the company matures, you need to become more proficient on this stuff. It happens to us that we need to do a lot of education. I think that's part of the same challenge that we find there. But no one thinks, oh, I'm raising equity and this is going to be 50% cost of funding. But when debt, you put it very clearly. That's a different way of seeing it. I think the best is just get out your Excel. This is a very simple task, or otherwise ask support to people like you.
Absolutely. There's a question from Hector Medina. I'll summarize it. He says they are in early stage deep tech, raised $500,000 from VCs and angels, but will be pre-revenue for the next 12 months. They are pursuing $2 million in grants, and is assuming this type of lending strategy wouldn't be an option for us. No, because they are pre-revenue and Lendity funds from like 1 million ARR onwards. But he also asks, what would be your take for early stage deep techs? I assume that in this case, public grants and equity are the way to go.
Yeah, this is a very easy one. Why would you get so debt? Very important highlight. You are signing a commitment to pay it back. And in this case, you don't have revenues. You have uncertainty whether you will have revenues. Why would you enter in that commitment? You'd rather just go through the obstacle and the pain and trying to find that equity investor than just thinking of getting that. No one is going to grant a loan, not because they don't like the company or whatever. The company does not have the ability to pay it back yet. And it's a crazy idea. And I think this is an easy one, easy use case of equity.
Yeah, it's 5:28, but I want to ask like a quick question because I think it's important. You mentioned that what you audit and what you take a look at is KPIs. And I said that like this is the new economy that you can like follow, not for everything, but certainly for subscription products because they are indeed a new economy. So what are these KPIs? Like when do you consider them healthy? What do you want to look and see like, all right, this makes sense?
Yeah, so the level of reoccurrence or recurrent revenues. So we want to see that revenues are reoccurrent, anything at 70% plus, it's ideal. The gross margins, we want to see 70% plus, 65% plus, depending on the type of business. The retention that they have, we want to make sure that the churn is actually controllable and the retention ideally is more than 100, meaning that they're increasing the revenue with the existing user base. We want to see that the company is growing. This is not a funding for when the company is not in growth momentum, and this anything below 20-30% yearly growth, it's not a fit. And then we cross-check many things that are soft, that are not necessarily quant. It's more qualitative stuff. As the one I mentioned before, what's the housekeeping quality, the data room quality, is this a mess, documents everywhere, not signed, they cannot deliver and so on. So there's a component of quantitative stuff and qualitative ones.
Perfect. Great. I think we should leave it here, although I could go on for a while on healthy unit economics, because that's something I also insist constantly in our webinars and in our training courses. So, well, it's 5:30. Thank you very much, Rafa, for your time. Thank you, all of the participants, for connecting. We're going to upload this webinar to YouTube probably tomorrow as well, in case you want to share it or whatever. In any case, feel free to send us an email, any help that we can provide, any collaboration, any like services you guys may need, any lending, of course, from Lendity, anything, you guys can write us an email or contact us in LinkedIn. So again, thank you very much, Rafa, for your time.
Thanks for your time as well, and thanks for the audience.
Thank you. Goodbye, everyone.